Today we're diving deep into a topic that affects us all, from Wall Street titans to the most innovative startups to our households and everyday life. In this episode, we'll uncover the impact of inflation on financial markets, explore the strategies businesses use to navigate the complexities of inflation, and catch a glimpse of the future where technology and economics collide. Erik Johnson, a name synonymous with economic wisdom, joins us to unravel the details of inflation, technology, and how they're reshaping our world. If you've ever wondered how to safeguard your business in times of inflation, if you're eager to hear about the latest trends, or if you simply crave invaluable insights from a bona fide expert, then this episode is tailor-made for you. We're about to take you on a thrilling journey through the realms of economics, technology, and the art of business survival in the face of inflation. Welcome to this episode of Articulate This. I'm your host, Pat Staliano, and I'm your gateway to the thrilling world of emerging technologies and the brilliant minds shaping our future. Let's get into it. Hi, everyone, and welcome to this week's edition of Articulate This. This week, we're going to explore inflation with economist Erik Johnson. Welcome, Erik.
Thanks so much for having me, Pat. It's a pleasure to be with you.
So before we get started into these questions, can you kind of walk us through what inspired you to become an economist and more about your role at the Bank of Montreal?
Absolutely. I feel like early on in my career, I kind of stumbled into economics almost by accident. I feel like originally I was going to be a political scientist and thought, that was the path for me forward. But, it was kind of circumstance of just, kind of taking economics classes when I was first in school and just really kind of enjoying, that way of thinking about the world of, really being kind of ingrained in looking at data, kind of allowing, kind of empirical evidence to inform policy choices. That really, I feel like, just like, maybe stirred something inside of me that maybe was a little bit more interesting to me anyway than just listening to people talk about political theory or, other things like that. So I feel like that was really the spark that kind of led me initially to economics. And then, I guess how I ended up kind of in the private sector side of things was, I think for a long point in my career, I really thought I was going to be, kind of an academic economist, but it took a long time to realize that maybe, you don't necessarily want to spend, 30, 40 years of your life sort of toiling away writing papers that maybe, a handful of people will read. And so what I really like kind of about being, more of an applied economist is you get to do, kind of a more mix of things, both kind of some of the depth and the analysis that you might have done in a more kind of academic role, but you also get to spend a lot more time thinking about how, macroeconomic trends are, having an intimate effect on day-to-day kind of policy and, kind of realities in financial markets and economies across the globe. And so I think that's really what, kind of brought me back to the private sector. And again, certainly it's a pleasure to get to spend time thinking about this stuff at the Bank of Montreal. And, again, I think if you think about where kind of economists who work in financial services sit, again, ultimately what a bank is trying to do is, lend people money and those sorts of related, kind of activities in the economy. But, a really important feature of thinking about, the risks involved with, kind of creating financial products and providing kind of the whole host of services that go along with those is, what's kind of going on in the macro backdrop, certainly in the Canadian and US context for, kind of a Canadian bank, but certainly now we're much more of a North American bank than we used to be. And so I think that's certainly a key feature of what a lot of private sector economists do is, kind of think about, where interest rates are going, where kind of GDP growth is going. Obviously these days as well, what's happening with inflation and kind of other issues, and certainly, some of the longer term kind of structural issues in economy. So, what's happening kind of with the, say like the imbalance between supply and demand in the housing market. What are some of the implications of that? And then, also thinking about things like, where would things like productivity growth and maybe the lack of productivity growth how is that a kind of interfacing with the economy as well? So I think it's, spending time thinking about those whole hosts of things, but, there's lots of other, I guess, more kind of regulatory activities that private sector economists have to spend time doing. So those would be things like, one important aspect, and I think we were all reminded of this back in March, is that, being a bank is inherently kind of a risky activity, right? A lot of your, liabilities are very short-term and maybe less stable in nature than you'd otherwise like to. And a lot of the assets you create tend to be, much more long-lived and, have much longer maturities. And, that mismatch inherently creates, some risks and some potential, calamities in a really, negative situation. And so, part of the activities of banks is making sure that they're holding enough capital to, to prevent kind of the worst from happening if, there is, some outside event that kind of influences people to maybe want to, grab their cash all of a sudden. So, economists at most banks spend a lot of time kind of developing scenarios to help banks and to help kind of leaders think about, how those situations might play out and how a bank kind of can better prepare for any situations like that. So it's a mix of those things. And then again, a lot of what we do is a little bit more consultative in nature. So providing people advice on kind of where we think the economy is going and, what kind of implications that might have for their business or, maybe for kind of their operations if they're more kind of in a public sector or kind of more of an NGO type role as opposed to kind of just a private corporation.
Amazing. So with all that said, like that's a perfect segue to get into the nitty gritty of what we're going to talk today. But can you provide kind of a brief overview of like what inflation is and why it's important for the economy to monitor?
Yeah, in many ways, this is, the $100 question. I think what, part of the challenge of this moment we're in where, we kind of went through, at least almost a period of 2 decades where really we weren't, having to think about what inflation was in the economy, even really to a degree, what interest rates were doing. And so we kind of got lulled into just a very different way of thinking of the macroeconomy than we certainly have been for the past few years. But I think one of the challenges is when we think of what we're trying to do with a concept like inflation is that, there's a whole bunch of prices out there in the economy when we go and buy things. And a challenge is trying to track, what's happening to the average price in, both the Canadian economy, the US economy, the global economy. And so really what we're doing with inflation is we're trying to come up with some basket of goods that we think is representative of what, a typical household might purchase. And then what we want to do is kind of track how the price movements of those different components of that basket are moving over a given period of time. So we often, kind of have this backward looking nature of inflation. So we often look back to, how the prices of that basket have evolved over the last year. And so I think it is important to think about, often we're talking about it kind of as this retrospective object as opposed to something that's kind of happening directly in the here and now, and, changing a little bit more that way. And I think the other, challenge that raises is that although, I think we're doing a much better job these days of thinking about what that average basket is, across a whole range of households, both at different ends of the income perspective, different demographic groups, that basket isn't going to look like that average basket, right? Some households might be spending a lot more of their income on things like shelter or things like food, and other people might be spending a lot more of their basket on some of the more discretionary services out there, say like eating out in restaurants. And so I think the challenge of communicating that in, this day and age is that you're not necessarily speaking to someone when we're talking about inflation in kind of terms that they might be intimately familiar with when they're thinking about their own balance sheet at home. And so I think that's part of the challenge is, you can, spit out a number of, here's what inflation has been doing over the past year, but that might not always hit home for someone who, again, might have, their kind of expenditure shares much more kind of in some of those categories that have really been, growing out of control in the last little while.
So how do you see modern technology influencing the measurement and management of inflation in the economic landscape today?
Yeah, I mean, I think this is a great question. I think we're going to still see, leaps and bounds of improvements in where we go about kind of measuring prices today. So if you want to think back to the way that we historically have captured macroeconomic data in Canada and the United States and really every kind of advanced economy, around the world is we often run surveys. And so we'll send a little, piece of paper, or these days it's often an electronic survey, questions maybe about how much revenue their business made, or, how much they spent, or in past cases, how much they might have spent on certain, classes of items and goods. And we'd often use that to sort of track things like inflation. Now, I will say we've made a lot of progress in the last, few decades of, how to do that kind of a lot better. And so, we used to send people out to stores, or we used to call stores up and be, what are you charging for a pound of butter right now? But these days, actually, what people do is they, go out with kind of like little scanners, and they go into stores, and essentially they're scanning a whole bunch of items that all go into a particular basket. And so for other things, a good example would be automobiles. It's a little hard to go into a grocery store and scan the price of automobiles. But what we might do instead is we might go acquire transaction data from, say, an agency like JD Power, or one of these other kind of big automotive data companies. And then that gives us some insight into, what might be happening kind of more in real time with kind of prices of new automobiles, let's say. And so I think that's, one of the major changes that we've made in the last few decades of how we measure prices is we're a lot better in real time of measuring what the actual cost of something is. And in many ways as well, I think, when we're thinking of, say, food inflation, which is, obviously, something that's garnered a lot of attention, and rightfully so, is we're also a lot better now when we're going in and scanning things of we can track sales. And so we're not just thinking about the actual price that's posted for something, but more the effective price that, someone's going to actually pay for that product when they go into a store at a certain point in time. And so I think that's one area where we've gotten a lot better. Now, I think the next kind of phase of where we're probably headed is more on the expenditure side. So often the way that most countries think about, that basket they're creating to capture kind of the average thing that a household is spending on is going to be a little bit more retrospective, and often will be based on survey data. So, we'll go ask a bunch of households, what did you spend money on last year? Which, certainly can be very useful, and we can use a lot of techniques to do that well. But ultimately, it's a little bit, backwards looking, and, does rely on recall. But, one thing that we are seeing some innovations on is just in maybe rather than doing it entirely with survey data, we can actually start using transaction data. So I think these days we're seeing a lot more kind of statistical agencies try to integrate, card spending data to maybe get a better sense of where those expenditure weights are going in real time. And rather than having to ask people or guess what an average basket is, we can then sort of try to actually construct what an average basket looks like using the data itself by kind of measuring what people spend. And again, that's never going to be perfect. Like, a lot of purchases are still made in cash today. And so that's something that you can't necessarily track with something like card spending data. But it certainly is a big innovation from even what we're doing today, which, again, we often update the basket sort of either on a yearly, or in Canada, they used to be biannual basis. And that's, again, going to look a little bit backwards. And so in situations like COVID, where all of a sudden I can't go out and buy services, basically, that's a huge change to the basket, and, is not necessarily going to be immediately reflected in what's happening to inflation at the time. And so I think, as we move more to that kind of real-time measurement of expenditures, I think that is going to be kind of an innovation in, again, kind of working towards constructing something that looks more like an ideal cost of living, index, as opposed to, kind of the consumer price indexes that we often track across countries today.
I was going to ask you about like the indicators, what have changed, what have stayed the same. And, I remember hearing about the latte indicator. When people have disposable income, they'll get from their favorite franchise, they'll get their latte. And if latte sales are up, that means they have more disposable income versus
Yes.
if they have less if they buy less lattes. Do you look at any data like that? You mentioned sort of transactional data, but is there any sort of products that you look at to kind of get an indication about that?
Absolutely. So I think, certainly it's been a little bit more challenging in like the last 2 years, because what you have to remember is, in addition to, say, some of the cost of living pressures that households are facing and then would influence, what kind of discretionary things they're going out and spending money on. There was sort of this big pivot of, in the heart of the pandemic, everyone just was buying way more goods than they normally do. And so now they're sort of rotating back to spending more money on services that they didn't really get a chance to consume for, certainly a significant portion of time during the pandemic. And so that does make it a little bit harder to track, kind of what's happening with the trends, because there's sort of this catch-up effect. And at the same time, there's sort of like a decline, right? People have gone from, spending tons of money on things like household durables to spending less on them. But, the sort of negative growth in spending on some of those things is just more a reflection of a return to normal as opposed to, say, a complete collapse of, kind of spending in those markets. But I will say, some things that are generally good barometers for those kind of situations are things like, in-person spending at restaurants, broad kind of travel and tourism spending. Those are kind of things that, a household is often going to, maybe step back from a little bit as kind of times get tougher. And certainly, as we're, seeing kind of this big interest rate shock work its way through the Canadian economy, certainly, but really a lot of global economies at the same time, those are often some categories that people step back from. Now, I think the other one that's often another great barometer is something that's not really going to behave that way, at least in my estimation. And that's, some of the big ticket durable items like automobiles. So again, people really couldn't buy new automobiles for, 2.5 years in many ways. And so despite the fact that it is a challenging time to go out and buy, a big ticket durable item just from where interest rates are, where kind of other cash flow pressures are hitting households and firms, just from the point of view that there was so much pent up demand built up, that's a category where we might actually see volumes increase despite kind of the otherwise, more dire picture on the macroeconomic side.
So you mentioned already COVID as being kind of a factor that kind of shuffled the economy in many ways, but I don't know what the exact stat is, but I heard something that, from a technology standpoint, a lot of e-commerce sites kind of accelerated development, like 10 years worth of development within 2 years because the demand was so high and they had to kind of get their infrastructure in order. And now we hear also about artificial intelligence and the automation and things of that nature. So do you see the progression of technology influence and or accelerate inflation in today's economy?
Again, so I think there's two things to think about here. So on the one hand, I would say the improvements in payment technology that have arisen over certainly the last kind of 2, 3, 4 decades. I think those in and of itself actually can have quite an accelerationist kind of influence on where inflation can go, certainly in periods of time where maybe money growth and demand growth is kind of a little bit running out of check, like we had during the pandemic, right? We had certainly a lot of fiscal spending to support economies. We had a lot of monetary stimulus to support the economies. At the same time, we had all of that chasing a very fixed supply of goods. And so the fact that it's very easy in a modern economy to go out and spend money, especially when we're ordering things online, as opposed to maybe having to go to 10 different stores, drive to all those places and buy those sorts of things, that can really speed up that cycle much more than if everyone was paying in cash, had to go to physical locations. So I think that's one aspect where you actually can see technology, kind of speed up those things. But I will say predominantly the effect that we see from technology interfacing with inflation is actually in a much more benign and positive way, and that's through productivity growth. And so I think that's certainly a challenge that we're facing in the Canadian economy today, is that we've been mired in this, kind of 6, 7, or even really almost like a 2-decade, low cycle in productivity growth. And so often what we see is as, certainly small businesses and large businesses, invest more in kind of new capital and new technology, that then allows them to be, much more efficient with their production processes, deliver kind of the same or even better quality goods and services they have in the past. And then those benefits are often passed on, the rest of the economy in the form of, say, lower prices and better quality products. And that really often has, quite an alleviating factor on, both wage pressure and price pressure through inflation. So I think that is really, in many ways, the pixie dust that makes, kind of the economies of the world work. And I think that's really, in my view anyway, like the primary way that we think about kind of technology interfacing with inflation. But certainly, it can accelerate it. And, another good example would even be, in situations like, some of the regional banking stress that we've seen in the United States, right? Like just the fact that it's a lot easier to move money around than it ever has been, certainly can accelerate a lot of these processes that used to happen in much slower times. And inflation is certainly one of those as well.
So let's talk a little bit about the impact on the financial markets and the emerging risks that come from it. In the context of rising inflation, how do financial markets, including Wall Street, venture funds, and lenders typically respond, and what role do they play in managing inflation?
Yeah, absolutely. So I think the probably the key thing to think about from the perspective of inflation in financial markets is, we went through this big period of time where basically borrowing money was almost free.
Yeah.
And so I think that really changes your perspective of when you're going out there making an investment decision, say as an investment manager or as a company, what does my return have to look like if I'm going to go out and make an investment or, buy some capital to kind of change the structure of my manufacturing plant. But in an era, when interest rates are now sort of, at the risk-free rate, on the short end, above 5% in the US and at 5% in Canada, that changes the arithmetic quite a bit. All of a sudden, if I'm an investor, rather than maybe investing, kind of in a company that's really on the, beginning of its growth cycle, I might start to think, well, maybe I need to start thinking about investing in a company that's currently producing a fair bit of revenue, has healthy profit margins, is paying, a dividend that's going to give me some cash now to sort of help my own kind of cash flow pressures. Because if not, I could, basically get a entirely risk-free, GIC where I might get, 5.5%, 6% on. And so just because it's changing that math on, what those alternative investments look like, it really reshapes kind of valuations across, financial markets. And certainly we've seen that play out in equities. We were used to the world of, kind of TINA equities, which is, there is no other alternative, right? When fixed income assets were basically paying nothing, as they were kind of in, that 2-decade period of low interest rates, it was very attractive for the average investor, for the average company when they were, investing kind of spare cash to put it in equities. And so I think what we're seeing now is a repricing for a world that's sort of starting to get used to the idea that interest rates, aren't immediately going to return back to the very low levels that we were used to seeing in recent times. And instead, are going to have to stay, a lot higher for longer as we kind of work our way through this last mile of the more kind of stubborn inflation we're seeing today. And so I think that's the big thing going on now. So certainly we're seeing that work its way through in equity markets. And I don't think that's necessarily a bad thing, right? I think, valuations certainly were, starting to get a little bit out of control kind of in the heydays of the initial kind of recovery from the pandemic. And now we're starting to see them come back a little bit more to kind of what was in line with, a historical perspective, especially when you kind of separate, at least if we're thinking of the S&P 500 context of, if you get rid of the kind of the top 7 big technology giants, then, certainly valuations look a lot more kind of what we might have been used to seeing kind of before the, low forever kind of view of financial markets. But I think that's certainly going to be a struggle for everyone kind of as we go forward, is that, it's not like an easy way of thinking about, well, equities are going to keep growing like crazy, because now there's a lot of alternatives out there that, certainly are offering a very attractive return. And in many ways, you're going to see that across the asset class, even in something like housing, which certainly is, an all-time favorite Canadian investment. But, the arithmetic looks a lot different in residential investment when there's other alternatives out there, that are, very easy to transact with, or, paying pretty decent real returns, and, don't kind of involve maybe some of the risks that, some of those kind of physical assets do. So again, I think it's certainly going to, take its time to kind of work through the economy. But again, if we think of, where markets are headed, say this year versus last year, 2022 was, a left tail event for both the equity market and the bond market. And so from the perspective of, having a time where there's a little bit more questions about, how resilient earnings growth can be, all these sorts of things, it's hard to have kind of another year like that. And so even a sideways market is still one where you can find much better returns out there than, one that we were used to seeing in 2022, which, certainly if you looked at a financial statement then, you probably, needed a fair bit of, of maybe a stiff drink afterwards, to not feel too bad about yourself. But certainly I think the comforting news was that it wasn't just you, it was, a very broad event that was affecting everyone in exactly the same way.
So you kind of mentioned, the uncertainty of what would happen for profits in this kind of climate where this is, and it's not what comes to mind is like a manufactured recession, and that's not the right word. But what I'm trying to explain here is like companies are seeing this and they're trying to slow down, not to encourage inflation. That's also why they keep raising the interest rates as well. So you're seeing companies hesitant on investment, maybe pausing hiring, maybe layoffs. Um, are you seeing that going through this sort of cycle will, do you think it'll work? Is that, do you see it working with these interest rates that are going there? As recently as the last week, I see both US and Canada have said that they're holding steady right now, but it doesn't mean that they're not going to raise interest rates again.
Yeah, so I mean, I think in our view, both the Bank of Canada and the Federal Reserve are sort of at their cycle peaks for where, their kind of both the overnight interest rate is and the federal funds rate is in the United States. But again, I think there's always going to be risks to that interest rate forecast going forward by, one, how stubborn kind of some of the, less volatile components of inflation. So that's stripping out things like food prices and energy prices. So how persistent they remain. And the second piece of, I think we're certainly in an era where, there's a lot of, both volatility in markets, but also volatility kind of in the geopolitical sense as well. And so something, like the conflict going on in the Middle East today is something that, could always certainly exert some force on where energy markets kind of go over the next year. And so, it adds a lot of uncertainty. So I think, I guess what I'm getting at there is there's both those global factors. And so those global factors are always kind of the question mark, is that, at least if we go back to the last year, they've kind of been, one of the reasons why we've actually been able to get inflation a little bit more under control than we were used to seeing kind of when inflation was, above 8% and above 9% on an annual basis in Canada and the US. But the challenge is, we've already kind of got that easy win, so to speak, right? Energy prices have sort of more normalized, and, we don't get to see kind of another big, downstep in energy prices kind of providing relief on inflation. And then the second piece of it is, over the past 2 years, we had this huge global supply chain dislocation. And again, that's something that really has very much recovered. And so that easy win of seeing kind of goods prices normalize, that's something that's a little bit more out of reach now. And so because those global factors, aren't really going to help us as much as they have over the last year, that last piece of inflation is a little bit more domestic focused. It's often, a little bit more related to what's happening with service prices, which again, the bulk of what, most households consume in advanced economies are services. And the challenge is services are most closely tied to what's going on with wages. And so, wage growth in both Canada and the US has been kind of in that 4 to 5%, kind of annualized growth basis. And in the US, it works a little bit better when you have, certainly very strong productivity growth, as we saw kind of in the most recent kind of US numbers of, above 4% sort of productivity growth on a quarterly basis. It's a lot more challenging in an economy where you're seeing sort of stalling or even negative productivity growth, as we've seen in Canada. And so I think that's, where interest rate policies are trying to kind of, curb that cycle or, create a little bit more slack. So the idea is, as you point out, right, when interest rates are as high as they are, certainly businesses become a lot more, concerned about, if I'm going to go out and make an investment, is the arithmetic going to pencil if interest rates remain this high? And so again, that's something where they might be a little, slowing down their capital cycle a little bit. That might also mean maybe they're slowing down kind of, what they're doing from a hiring point of view. And then that feeds itself on into other parts of the economy as well, right? So if I'm a homeowner, maybe, I'm less likely to want to trade up because, rather than, having a mortgage during some of the heydays of the pandemic at, say, 3.5%, 4% for a 5-year fixed rate mortgage. Instead, I'm looking at a mortgage rate that's maybe in the 6.5% to 7% range. And then if I have to qualify for the stress test, I'm maybe qualifying at above 8%. And so that's a very different kind of decision for kind of participants in the economy. And that is really what we're seeing today in the Canadian economy, right? We basically have seen 6 months of almost a stall in growth. And that's really reflecting this really challenging environment where you raise kind of interest rates by 475 basis points in a very short period of time. And, I think we're really going to be, going through this kind of interest rate shock pain, until interest rates start to come down. And the reality is, there's still roughly about 50% of existing homeowners out there who've yet to kind of face that interest rate shock. And so I think that is certainly the pain that's working its way through the economy, is one of the reasons why we're seeing, kind of spending slow down in the Canadian economy, much more so than in the US economy. And a lot of that goes exactly back to the mortgage market, right? The US is, not just unique from the perspective that I can go out and buy a 30-year fixed rate mortgage. as a residential lending product, but it's also by far the majority lending product. And that, is very distinctive in the world. And it, dates back to kind of the US federal government becoming very involved in the housing market after the Great Depression. But certainly it insulates a lot of households from this interest rate shock we're seeing, kind of play out in a lot of other economies today. And so instead, where other households might be saving and, worried a lot about, how much they need to build up to kind of make the arithmetic work on a mortgage renewal, instead, you see a lot of kind of US households over the last, kind of few months, spend some of those excess savings on, powering kind of consumption forward. And so I think that's kind of the challenge of where we are today. But again, because the more stubborn part of inflation we're left with is a lot more based in services. The only real tool that kind of, central bankers have to play with here is the interest rate policy.
Are you seeing technology used to help mitigate this risk at all from a lending perspective or from a banking? Have you seen any emerging technologies used, or are still the traditional ways of how this is being done is still being utilized?
I mean, I would say like there's a whole host of innovations on, just how we go out and evaluate kind of potential borrowers today, just with, a much better access to kind of real-time data than we've ever had. So I think that certainly is, changing the way that, kind of banks can do business in this space in many ways. And I think ultimately, create better products for customers that, better match their needs, as well as, just being able to kind of, better navigate and understand kind of credit risks that are out there. And so ultimately become better lenders themselves. And so I think that's, a really important aspect of any lending relationship, because I think what banks, more than anything are meant to do is, really understand the customers that they're working with and provide them with products that make sense for them. Because I think when banks do that really well, that's kind of when you see them performing, their very important role in an economy of, kind of providing, finance to companies that otherwise wouldn't have access to it because, they're not the Apples and the Googles of the world who can just go out and raise a bunch of capital on, kind of public exchanges in the same way. And so I think that certainly is something we're seeing. And I'd say we're still in the very early phases of it. Certainly there's banks generate a lot of data, as, in the same ways that a lot of technology companies today generate a lot of data. And I think we're still in the very early phases of seeing, kind of generative AI and other, kind of analytics work their way through to kind of make the best use of that data in one, understanding trends that are going on there that are, hard to parse just for a human sitting down looking at, a spreadsheet to kind of work through, just because there's so much out there. And then, I think taking advantage of, non-traditional forms of data that, were hard to kind of use in the past until you had some of these tools. So yeah, looking at things like text analysis and other things like that, or even looking at image analysis, but really help you kind of better understand the landscape out there in a way that didn't exist before. So that's, I think, certainly true on the finance side. But, also I think you're seeing a lot of instances of companies having opportunities like that. So in an environment like we see today, right, labor costs have been, certainly one of the major focuses of, any business kind of trying to operate in the space today, particularly for small and medium-sized enterprises that, really, kind of were, I think in many ways, faced with the kind of the biggest shock of this, labor market we had that was extremely tight, and it was very hard to kind of go out there, one, to attract talent, but also to retain the talent you had today. And so, one example I can think of today is, you're seeing a lot of, kind of operators, say in the restaurant space, realize, maybe rather than the traditional way of thinking of how you run a restaurant where, people come into your restaurant, they sit down at a table, maybe 10, 15 minutes later, someone comes by and takes their order. And so you have, this kind of one, gap in time where you're not earning any revenue from people, but also, it's a little bit more expensive from, a labor side to kind of operate a model like that. Instead, what you might see is now more and more restaurants are having maybe more of a counter service model, or, having some technology kind of help them with that initial ordering or that initial customer interface process. And so one, that's a way for a business to kind of save costs or use technology to kind of mitigate, a real kind of cost pressure that's emerging in this cycle. And again, also maybe provide some opportunities to enhance their revenue cycle, because, they're taking time that maybe wasn't as productive from a business operating point of view and turning it into time that is actually productive. Because by the moment someone sat down at a table, they've already made an order, their drinks are already in, And so they're instantly kind of, creating revenue for you. And so I think that's a good example of where, technology is kind of finding ways to, relieve some of the pressures we're seeing on business today. But, certainly by all means, it's not going to be a silver bullet for every business model, for every sector, certainly.
Yeah, definitely. I've seen how it could potentially push things downstream. So
Yeah.
you may find efficiency in one area, but maybe not as you go further down the chain. Like the examples you gave for the restaurant is a perfect one. So that is an interesting thing. You did kind of mention policy, so I do want to cover a little bit of like what does government and technology advancements, how can they work together to address inflation and promote economic stability?
Yeah. So, I mean, I think, again, maybe on the, kind of statistical agency side or more the back end side, I think, certainly encouraging, those entities around the world to just, continue to innovate the way that they're measuring and tracking kind of prices and expenditures, I think is just going to ensure that, we're doing a better job of understanding kind of the challenges out there. And not just that, but understanding the, kind of the granularity of the challenges out there. Because that, as I mentioned off the top, it's not just one basket of goods and services that people buy, it's a whole range of them. And so I think the more granular, we have access to data and how those things are evolving over time is just going to give us a much better appreciation of how, these challenges are, being reflected at different, for different households and different demographics. And so I think one that helps you, that helps policymakers better understand the problem and, craft solutions that are a little bit more targeted to, kind of addressing those, I guess. And it goes back to idea, when you think of how a lot of governments, kind of responded to the inflation crisis initially, they were mostly just cutting checks to everyone. And, certainly that's one way of solving a problem, but there's, going to be lots of households that you're writing checks to that, don't necessarily need the checks. And so in many ways, you're maybe not targeting kind of that policy intervention in a way that helps, the broader macroeconomy. Maybe it does on an individual level help those households, but you're also giving a lot of income to people who then are going to go out and spend that and, increase demand even further. And then maybe, that's going to feed into kind of more inflation in the future, as opposed to actually solving, the problem you wanted to solve to begin with. So again, I think that does help a little bit from that kind of policy targeting point of view. But honestly, I think the biggest role that governments certainly have in, providing solutions to, kind of economies on issues like inflation is is setting the rules of the game and, kind of creating infrastructure that then allows kind of households and firms to go out there and, become a lot more productive. And so in the Canadian context is, finding certainly policy levers that are to help Canadian businesses, become more productive tomorrow than they are today. Because ultimately that's the thing that's really going to deliver, not just lower and sustained inflation in the economy, but also, better standard of living going forward for, all households. And so I think that is really the thing that most policymakers, I think, really need to focus on if they want to, make the biggest difference in this space. And again, I think that's, certainly setting the ground rules to make sure that things like generative AI, find easy and, profitable adoptions across a range of kind of sectors and business models. And again, making sure that the rules of the game are out there to kind of help both small companies as well as, kind of public entities kind of manage things like, the transition towards kind of a net zero economy. So I think those are all the things that I think government is best suited to do. But I think it challenges governments in these days and age, often, at least recently, have turned to the idea of, we need to provide big, deep subsidies for kind of very specific sectors, to kind of drive that change. And I think that's not always necessarily the best way to go about things. Because again, I think what governments can do really well that other, participants in the economy can't do very well is set, kind of both efficient, fair, and productive rules of, engaging in kind of, the economy and society. And so I think that's, when they're working at their best, they're doing those things well. And again, I think in the Canadian context, certainly solving, some of the acute issues we're seeing today in housing affordability is going to go a long way to ensuring that, we manage kind of our inflation challenge going forward. Because certainly one thing that we're seeing a little bit of a divergence between Canada and the US today is, a lot of the US, inflation kind of trajectory going forward is really more on just the pure service side, like excluding house prices. But in Canada, really, a lot of the components that go into kind of shelter prices today are still, very big drivers of why inflation today is above target. And we're not seeing kind of that real-time relief that we are in the US. So, despite the fact that, CPI rent in the US is actually still a little bit elevated like it is in Canada, all the real-time data points to that series eventually is going to fall, because if you look at what's happening to real-time rents in the United States, they already are kind of declining on a year-over-year basis. But we're not really seeing that pressure in Canada. And part of that reflects this idea that, if you want to kind of, make society more affordable for, not just existing Canadians, but, kind of future new Canadians as well, is, you need to kind of, solve what's happening between the imbalance between demand and supply in the housing market, and make sure that, the average household can go out there and, pretty readily find a stable place to live, because that's going to allow them, one, to, go to labor markets where, they're going to be, able to pursue the job that's the best fit for them. And, they're not going to be kind of wasting, hours and hours of their day commuting, across huge spaces of time, huge, geographic space to get to a job, because, that's where they can get a job, but, it's impossible for them to afford to live anywhere close to it. So I think that is certainly a big feature of, where governments, at least in the Canadian context, can play a role in, I think, solving at least one aspect of the living standards challenge that we're seeing today.
So, what macroeconomic trends related to inflation are you currently tracking, and what impact do they have on the financial products and markets?
Yeah, so I think certainly we talked about this earlier, but
Yeah.
just where global energy markets are going to go as a result of some of the kind of dislocation and conflict we're seeing in the Middle East is certainly a trend to watch. I think what's challenging is we saw kind of last year very intimately what can happen when energy prices certainly become elevated. It makes the job of the average central banker that much harder, and so I think the more we're going to see volatility in energy prices going forward, the more challenging it's going to be to bring inflation back down to target. Because again, gasoline prices and those things really get written into a lot of contracts if they stay elevated for too long. So that's certainly one trend I'm watching. And then the second kind of two trends that I think I'm watching hand in hand is, ultimately what's going to happen with kind of wage growth as well as productivity growth. Because again, it's the combination of those two things that's really going to pin down where those more kind of stubborn last mile problems with kind of service inflation are going to go. If wage growth can ease a little bit at the same time we get, better numbers on productivity, the balance between those two things can make getting inflation back to target that much easier for kind of central bankers. And then, that's a world where they can be a lot more comfortable about saying, I think, we've managed this challenge, and now we can start thinking about bringing interest rates back down to, less restrictive levels. And that really is the lever that's very important for providing kind of some affordability relief for households. Because again, as long as interest rates stay as high as they are today, that's really going to continue to be, the big downside risk for both firms and households going forward, certainly in the Canadian economy, but really, across the globe as well.
So, we did talk a little bit about the auto industry and how COVID wasn't really that much of an impact due to due to the way things were run at the time. But how is inflation? How is inflation impacting the industry today, or it isn't? And how do you see technology managing these effects, if any?
Yeah. So, I think, the auto sector, again, was, one of these poster childs for every single possible supply chain disruption you could ever have, whether it was, factories having to shut down because of various, waves of COVID outbreaks. And then, the secondary kind of big shock they had was obviously just on semiconductor shortages, is, they weren't the primary,
Mhm.
kind of consumer for semiconductors. And they found out that, when those things are in high demand, it's very hard to get your hands on them. And so when you had that real constriction in supply, it meant that, all that demand was chasing not very many vehicles. And you saw prices in the new market certainly go crazy. But again, even more so in the used market, which, relies on a lot of channels that basically completely turned off from a supply point of view for the last 3 years. One is when people don't buy new cars, there's no trade-ins going to the used market. And
Yep.
when, rental fleets weren't out there buying new cars as well, they weren't kind of recycling their old vehicles into that market as well. So I think that's certainly the one issue that's been top of mind in the auto sector, is that, we're seeing this period of time where the auto sector has been able to kind of, skate through despite the fact that it was running on recessionary levels, and from a volume sense, margins were very strong, and so that was kind of a boon to the bottom line of both producers and dealers. And now we're sort of entering this time where margins are still relatively healthy, but just because of availability is a lot better, we're actually seeing volumes kind of go up despite the darker kind of backdrop on the macro side. But again, I think that the issue here is, and we certainly will see some of this with the kind of new labor contracts by the United Auto Workers and Unifor, is new vehicles today have almost pushed into the realm of becoming like luxury goods, just at how expensive they've gotten from a pricing point of view. And so any additional kind of lift on vehicle prices as we go forward is going to just make more and more vehicles kind of out of reach for the average household. And so that's certainly a challenge for a market where you're used to thinking about at least in the Canadian context, your big selling vehicles like things like the Ford F-150 and these other kind of big pickup trucks. But when those things are getting too pricey for the average household, it means they're going to be trading down the quality ladder to buy less pricey vehicles. And so it's going to certainly provide a bit of an adjustment cycle where the vehicles that you didn't used to think you would be selling as many of are just going to become more popular vehicles, just from those are things that people can afford. And I think you're even seeing that a little bit in the electric vehicle space today as well. Is one of the big defining differences between a conventional vehicle and electric vehicle is, on average, electric vehicles are quite a bit more expensive today than, say, buying like the equivalent internal combustion engine. And so in an environment where it's very hard to get the arithmetic of financing a new vehicle purchase to work, if something's that much more expensive, it's going to make a household less willing to buy those. And what we've seen, certainly in the two provinces in Canada that have the most acute affordability challenges, which are Ontario and BC, because again, that's where kind of housing is the most expensive. We've seen kind of a step back a little bit in the share of electric vehicle purchases in the most recent data. So that would be in the second quarter of this year. And so I think that's broadly reflective of this idea that, like, if you want people to kind of transition to a new class of vehicles, you have to make the arithmetic work for them. And the way that you do that is, again, by certainly by improving the efficiency in your production process, making those vehicles more affordable to kind of the average household. But again, I think there are certainly some upsides as well. Is one of the I guess kind of potential cost saving measures, at least on the production side, is electric vehicles do consume fewer parts when you're building them. So on average, there's about 30% less labor content that goes into an electric vehicle. So that does potentially provide some savings from a production point of view, as that technology kind of gets a little bit more mature. And again, how you can integrate that potential with some of the potential innovations from generative AI and how they might allow you to make kind of better real-time decisions in the production process itself. I think those are kind of levers that we'll really need to rely on if you want to make these things not just widely available, but also at a price that the average household can get into. And I think what's easy to forget is when we talked about this at the beginning, right? Inflation is this measure of the changes in prices. But the reality of the situation we're in today is, yes, maybe the rate of change of prices has dampened from what we saw kind of in the height of this inflation shock cycle. But from a level point of view, right, food prices today are still 20 to 25% higher than they were in 2019. And that, unless we get some big food deflation, which is certainly a little bit unlikely with where kind of harvests are going, that relief never kind of shows up for households. And so instead, what households need to kind of eventually catch up is they need earnings growth to kind of outpace where inflation goes, over a sustained period of time. And so I think that's the world that we really need to, be transitioning into if we want to see some of these kind of pressures across the board, ease from making the arithmetic work for a whole range of purchases across the household spectrum, whether it's, being able to buy a new home as a first-time buyer, or to go out there and buy, a vehicle that I used to be able to think, was affordable, like, kind of popular vehicles, say like pickup trucks today. So I think, again, that's the world that we really need to see kind of take hold if we want to have, both, a better future from a living standards point of view, but one that, maybe lands a little bit more in that soft landing camp as opposed to something that's, a much more severe kind of macroeconomic backdrop to be operating under.
So let's talk a little bit more now about small and medium-sized businesses. And they often face unique challenges. How do you see rising inflation impacting small business, and what strategies can they do to employ these to navigate these challenges effectively?
Yeah, so I'd say, I'd say on the upside, I think one thing that generally does help, at least when you're in, say, some kind of, consumer facing sector, is, inflation is sort of automatically at least incorporated into your operating model. And that, like, if inflation is higher, it generally means you do have a little bit more ability to kind of pass on prices to consumers. I think the challenge is, if you're a little bit more on the smaller side of certain sectors, you might just be in a space where you don't have that leeway to pass on as many costs as you did maybe previously. So when there's a big global shock to prices, as we saw certainly with what was happening with energy prices, that's very easy to kind of pass on to consumers because all your competitors are going to be doing it at the same time. And so I think that will be the challenge for small businesses to navigate today, is that when we're seeing a little bit more idiosyncratic kind of cost shocks in this environment. So maybe that's more on the labor side. You might be experiencing different kind of labor turnover and retention issues than maybe one of your competitors. It can be hard to kind of pass those costs through to your, kind of your consumer facing prices. And so I think that's one aspect of this inflation episodes that's most challenging for small businesses, is that often they don't have that same leeway that, say, one of these big, say, platform operators often has when they don't face the same competition. So again, I think that's certainly one aspect. And then, I think what comes up is, are there solutions, say, on the technology side that you can use to maybe address some of those idiosyncratic issues that, let you better absorb those shocks? So I think, certainly the example we talked about in the restaurant space is, can I employ maybe different operating models where I'm relying a little bit more on capital to do some tasks that used to be all labor? And so I think finding those kind of opportunities is one. So maybe in the context of other sectors as well, are there opportunities to find software that might be handling some aspect of my business that I used to have more labor content doing. And again, maybe those things have a higher upfront cost, but if you find a way to kind of make the arithmetic work, they can provide you some cushion on maybe one shock that you're currently struggling to deal with. But I think ultimately, the challenge going forward for small businesses is that we're in an environment today that it's a lot harder to pass on those costs to consumers. And in particular, it hurts small businesses the most.
We did talk about this a little bit earlier as well. So I wanted to ask about the concerns that SMBs have during these inflationary periods. When they need to secure funding, whether it's venture funding, business loans, and what are the types of innovative financing solutions they can explore?
Yeah, so I think we're still in the very early days of this, but I think a lot of upstart fintech companies are really starting to get into this space a little bit more. So like a good example would be, like some of the payment technology companies, say like Square, when they started out, they were really just providing, kind of POS technology to customers. But I think as a result of, being able to kind of look at data from, a whole range of, their customer, kind of base, they're now able to kind of come up with kind of customized lending products. And so maybe I think that's a space where, they're entering a market where they didn't used to be. So they're providing more competition for, I think the traditional kind of banking finance operators to help kind of small businesses in a way that wasn't available before. So again, I think we're still, not quite in the world where we've seen kind of them, be a big enough participant in the market to kind of have a sense of how that might change the game in terms of, offering services and offering, kind of more custom solutions than we might have seen in the past. But I think those entrants into that space are certainly a positive for small businesses, because again, these are often firms that know, a little bit more about, what your account receivables look like, what all these kind of other aspects of your business look like. So again, there's the potential for them to kind of offer solutions that might not otherwise be there. Now, the challenge, I think, is always on a pricing point of view. So I think, banks often do provide, potentially, lower funding rates to you. But I think in an environment like this, what's challenging is, when financial conditions tighten, it's often small businesses that feel that pinch most often, because they don't have a lot of these other alternatives to turn to, like large firms, right? I can't really issue my own debt. I can't, issue kind of equities in exchanges. Often it's very hard to find some private equity firm who's going to, invest in my company to kind of provide, that, capital cushion for me. And so again, I think these kind of, these kind of entrants certainly provide an alternative for firms. And then I think you're seeing a little bit as well with, a lot of kind of more traditional private equity players, like Blackstone or others, maybe trying to operate a little bit more of like the Berkshire Hathaway model of being a lender, right? They're, often relying on, say, cash flow from insurance businesses and other kind of funds like that to, start lending money. So we're seeing that a little bit more in, spaces like commercial real estate lending. But I think those are other kind of, kind of potential innovations you might see out there in the future of, some of these non-bank entities getting a little bit more into other kinds of lending. And so again, I think sometimes having those alternatives is something that is a positive for small businesses out there. Because I think, they're always at the leading edge of any kind of tightening financial conditions. And the challenge is, at least for the longest point of time, really the only game in town was, to go to kind of the banker that you had, to kind of, extend any kind of amount of lending you might need to make the, kind of cash flow of your books work for the time being.
So we talked a little bit about how, SMBs could leverage technology to help automate and kind of lean on software to kind of improve workflow and operations. But how can they adapt their business models to leverage technology to remain resilient in the face of inflation?
Yeah. So again, I think there's a whole range of different things. So I guess if we wanted to take an example in, say, like the auto industry, one area that certainly I think, opened people's eyes up to during the pandemic was maybe I don't have to think about my business as just selling to some regional market. Instead, what I can think of is maybe a lot more of my leads I can get, from a whole range of geographies. And so whether that's, kind of relying a little bit more on an online business model, at least to kind of be your initial contact point with customers. And then, being able to kind of deliver goods and services, maybe, across much larger geographic spaces as a result of kind of, having a little bit better access to kind of technology and online sales and all those sorts of things. So I think that's one aspect that I think, businesses can really take advantage of. And certainly we saw that with a lot of, kind of auto dealers where, you didn't actually maybe have to physically go in and sign for a vehicle anymore. It provided a lot of opportunities to reach customers that were basically completely out of reach before. I think another example is, depending on your business model as well, is, from an employee side, right? Maybe there are instances where you can, hire someone to work for you that doesn't necessarily have to be in your physical geography. And that's opening the pool of potential workers, to be much wider for you. And so if we think of one of the challenges of the current episode for small businesses, is just hard to find people. And so if you don't need someone to necessarily man a retail shop, but instead maybe we're thinking, of hiring for different aspects of, your company operations, is, opening the pool of potential applicants up to bigger space allows you to maybe resolve some of those challenges that you might have originally faced by just having to kind of focus on a small local labor market. So I think those are aspects that I think, technology is really making a difference and will continue to make a difference for companies who can kind of take advantage of those. But I guess, some other examples too are just, again, maybe taking advantage of the fact that when you're delivering kind of goods and services, you don't always have to think of, like, maybe like this big distinction between brick and mortar and kind of e-commerce sales, but you can also often, use these things a little bit more complementary. And so I think we're seeing that even, with some companies that were very reticent to use e-commerce sales at all. So I guess, one example would be Canadian Tire, who, for a long time were very resistant, at least because it's a little bit more of a franchise company, but they were very resistant to kind of using their e-commerce platform to drive, kind of brick and mortar visits. But I think you're seeing, even a company like that really take advantage of the potential integration from that, is that even, if people are still coming to your brick and mortar store, having that integration, that complementarity between what you're doing in an e-commerce space and, how it's being delivered to, kind of maybe your physical locations, really provides you kind of some new ways of both reaching and retaining and offering kind of better service to customers. So I think there are lots of examples of, I think, companies kind of taking advantage of that. And it's very useful to maybe not always think of things as being complete substitutes for one another, but really sometimes even opening more doors to the way that you operate your business.
Amazing. So let's talk a little bit more about you, Eric. Outside of your professional life, are there any hobbies or any interests that you like to do?
Yeah, I will say I was quite a big runner for a long time. Like mostly like long distance kind of stuff. But I will say it's dialed back a bit. I adopted a dog about a year ago, so I will say my running has definitely taken a back seat to dog parenthood. But that's certainly probably the biggest hobby I do outside of thinking about the macroeconomy, certainly. And then I guess
With
the other big one is I'm a big foodie, so certainly going to restaurants in the city and then cooking a lot of food myself as well.
Awesome. So you're also helping with your those indicators in the restaurant to get an idea of what where the impacts are.
Exactly. Yeah, doing my part.
Actually, it's a good segue to the next question I was going to have is like, how do you stay up to date with all the latest trends? Like, technology is rapidly evolving. There's so much data points right now. So, with all the noise, how do you stay sharp?
I mean, I think the simplest advice you can give anyone today is read. And I think what I'm seeing more and more, both across the private sector, but really everywhere in today's economies, I think because of just how in your face technology is, with just your phone is always in your pocket, all this social media is always bombarding you. It's very easy to be distracted. And so I think fewer and fewer people actually, are able to find the time to sit down and read things. And so I think honestly, the more you can actually carve out that time, whether it means, having to, make some, make some maybe more stricter settings on how your phone is like available to you. But I think that is really something that's going to set you apart. Because I think what I find is you go into meetings and people will often be, oh, didn't have time to read this or haven't read this yet. And so if you're just one of these people who's out there actually reading things, it's really going to, I think prepare you a lot better to think about, one, just know what's going on out there, but also, come across, new creative ideas that you might be able to kind of use in your role or your business or your life. So I think that's first and foremost my simplest advice. But, I think there's a whole range of things out there. So I guess, I spent a lot of time in the academic world, so I still spend a fair bit of time kind of reading academic articles and those sorts of things for, ideas on, where people are kind of seeing these new macroeconomic trends emerge and, how they're thinking about them. And so certainly I find those very useful. Some more accessible ways for people if they want to, read more economics type stuff is, all the central banks, and in the US, the regional central banks publish really good working papers. So I think that those are always like really, kind of fascinating things to take a look at if you're interested in that space. I will say, certainly for real-time stuff, I still do, and certainly in the past have spent a lot of time, sorting through the platform formerly known as Twitter, just for like first coming across new ideas. But yeah, I think, other areas, certainly there's still lots of great stuff out there in the traditional, newspapers of the world. But yeah, so normally like I'd say a mix of those things. And again, I think the other thing, much like this is, there's lots of great podcasts out there. In many ways, there's too many podcasts out there to really listen to them all, but there's also lots of great economists and like econ adjacent podcasts out there that, can be really helpful, especially if you're like first trying to find out about something. I think they can provide some really great introductions to topics. And even there's others that really get into the weeds of things as well. So I think that's another, kind of source that I often tap into as well. And then I guess one thing that, certainly we have, at least in a more local context, but, the US has very similar ones as well, is there's lots of like kind of applied business economists associations. So we have one in Toronto, there's one in Canada. The US also has an applied business economist association. And so those groups often put on really helpful webinars on, pretty in-demand topics, I would say. And so those are really useful for getting a sense of how different people in the profession are thinking about things, how they're kind of maybe managing some of the challenges today that, is making forecasting challenging in a volatile world. So, just learning from your peers that way is super helpful. And again, yeah, I think like any job, getting to work with really great colleagues is certainly something that's very helpful. And, so just spending time, sitting down with your colleagues and understanding, how they think about the world, what things they kind of turn to, and even just, reading what they write and all these sorts of things, I think can be a really great way to, not just learn things, but also just, think about, oh, that's a really good way of, phrasing that idea, or, really a good way of communicating that. And so I find, those are other areas that can be a very helpful way to learn for certainly anyone, no matter what point in their career they're at.
Are there any projects or experiences that stand out that impact you professionally or personally?
Yeah, I mean, I think early in my career, I got to do a lot of very like compelling things. So I got to work in Washington for uh, for a few different gigs. So one of them was working for one of the kind of development banks there. So I feel like that was a very transformative experience for me, and just that I think getting to work in a big kind of policy place like Washington can get you. It can certainly is a very exciting place as a young person to kind of see the world for the first time functioning. So I think that was a really informative experience for me. And again, I think it opens your mind to, what different kind of things you can do, say, if you work in something policy related or, something kind of economics adjacent as well. So I think that was an experience that really meant a lot to me. And then, I think, I got to go to school in the US. And so I think that was another, eye-opening experience for me, just in terms of the colleagues you meet and in terms of the kind of different life experience you have. And, to be able to bring that back to, wherever you end up taking your career, I think, can really help you. I think just understand the world differently than if you, always kind of had the same, maybe experience kind of throughout your career.
What does a typical day look like for you?
I think it varies a fair bit. So, sometimes we're doing this kind of stuff where we're out there kind of, speaking in front of people, offering our views on kind of, where we see the macro outlook going. But I would say, one of the things that I, love about my job is I get to spend, a fair bit of time just reading and catching up with, all the various things that are going on in the world. So I think that's certainly something that, I wouldn't be able to do my job well if I didn't have the time in the day to actually spend time figuring out what's going on and, how that can maybe help us inform, where our forecasts go and all those sorts of things. So it's a range of that. And then, like anyone, certainly spend a fair bit of time both reading and writing email, as always. And then, I'd say the regular kind of day-to-day stuff of, either, kind of doing the prep work for research reports or, kind of writing reports themselves. But yeah, I guess, certainly these days I do, depends on the day, but I do spend a fair bit of time coding as well. So.
Oh, really? What when you say coding, you're actually building websites? What are you building?
It's mostly kind of either on the data analytics side or, it's kind of building tools to help us kind of do our jobs more effectively or repeatably. But yeah, I think, that's certainly something that I would advocate for young people is that I think, the more and more if you want to work in a field that uses data. And again, I think it's, having to know every nuance of how to code is going to become much less relevant as, kind of AI, becomes more of an integrated tool. But I think just understanding and being familiar and being comfortable working in that space is, I think something that's going to set you apart. And certainly is going to continue to be the case for, certainly decades to come until, we're in the next paradigm, certainly.
As we wrap up, what final advice or insights do you have for businesses all sizes, including small business, to navigate the intersection between technology and inflation?
Yeah, so I mean, I think the hardest thing in kind of this episode of where we find ourselves is, being in a situation where you're overextended, right? So with, kind of cost pressures being a little bit outside your control, with interest rates being really high, the challenge certainly in an era where it was very easy to accrue debt, to spend too much, to kind of acquire business and those sorts of things is, trying to right size, where your footprint is to kind of manage those challenges. And I think that's, a hard thing to do and can be a very painful thing to do. But I think, as you saw kind of a lot of technology companies go through in the last, year and a half or so is, being in a situation where you are a little bit right sized for the operating environment. So maybe one that's not going to be, the very sexy double digit growth number, but maybe one where maybe the level of what sales are going to look like is going to be healthy, but maybe the growth is going to be a much smaller, even maybe a negative number. Being able to operate and be flexible in that kind of environment is one that's going to set you apart. And so again, I think it's, a challenging one to kind of operate, but I think, certainly being right sized for a world where interest rates are high and potentially, costs are going to stay a little bit more elevated and it might be a more challenging environment to pass those costs on is one that you have to be able to navigate well. And, certainly one thing I would advocate, any small businesses, I think this is certainly the time to be reaching out to your lender and asking them, are there solutions we can come up with to make, the arithmetic of where my business finds itself today work better for both me and you? Because I think that's a call that, your lender really wants to receive. And I think one that they're often willing to kind of partner with people. And so I think that's certainly one thing I would encourage any kind of small business to do is I think, banks certainly want to be as creative as possible for their clients. And I think this is certainly an operating environment that demands a lot more creativity than normal because, it's very easy to operate in a world where, you can borrow money for free and there's, huge amounts of growth out there to, kind of sell products to people. But one where it's, both of those things kind of move in the opposite direction, can be one where you have to make a little bit more prudent choices and, being able to operate a little bit more lean and efficiently.
For those aspiring to follow in your footsteps, are there any personal lessons or experiences in your career that you'd like to pass on?
Yeah, I think the best thing you can do is just be curious. I think curious people are going to be people that stand out, not just in job interviews, but in their kind of positions themselves. And so I think that's one thing, be in a sector where you're doing something where, you know, day in and day out, listen, every job is going to have its up and down and its headaches. But if ultimately you're doing something where, you really enjoy the day to day, that's going to be something that's going to really help you kind of stand out. And then I think, maybe, there's always different ways of maybe getting ultimately to the area you want to be. And certainly if you're a young aspiring economist who wants to work in finance in Canada, the reality is, at least in the financial industry, we don't have a lot of banks, and the, economics teams in all of those banks are quite small. And so it, irrespective of, who you are and how great you might be, you might just be in a cycle where, the kind of the turnover doesn't favor, you finding opportunities in that space. And so being able to find more creative ways of maybe doing something that doesn't seem as applicable, but might actually, kind of power you through. So I guess one example in my context, I started out at the bank mostly writing software on the risk management side. And the position I'm in today is sort of one that kind of fell into my lap as opposed to one that I had to apply for. And so sometimes, being maybe willing to kind of, go in a direction that you don't think will take you where you want to go is certainly advice that I would advocate. And certainly in the financial space today, risk management is an area that's going to be a continued area of growth for, all participants in the financial services industry. And so, being willing to find kind of, jobs and areas in that space that, you could, really enjoy, I think is a really great way to get into the industry.
So for people who want to get in contact with you, what's the best way for them to get a hold of you?
Yeah, well, certainly, you can go on the BMO Economics capital markets website. My email's on there. I'm also on the platform now known as X at Erik Andrew J. Again, I'm also on LinkedIn as well. So certainly, people can reach out to me on any of those platforms.
Thank you so much for joining today, Erik. It was a great discussion. Learned a lot about the impacts of inflation. I can't thank you enough. Thank you for joining today.
Oh, my pleasure, Pat. Thanks so much for having me.
Take care, everyone.